What if I told you the safest asset in the world is only safe because everyone agrees to pretend it is? Not gold, not real estate, not your bank account. U.S. government debt. For decades, U.S. Treasuries have been labeled risk-free. That phrase sits quietly inside pension funds, insurance models, mortgage rates, stock valuations, even the formulas that decide how much capital banks must hold. Risk-free. Now imagine a single day when that assumption breaks. Not a default, not a missed payment, just doubt. What breaks first? Because here's the uncomfortable truth. The global financial system is not built on cash. It's built on trust in U.S. debt. And that trust underpins roughly $26 trillion of outstanding Treasury securities, the backbone of global collateral. This matters right now because U.S. debt has crossed $34 trillion. Interest payments are one of the fastest growing line items in the federal budget. Foreign buyers are no longer absorbing debt the way they once did, and higher interest rates mean refinancing old debt is becoming dramatically more expensive. The system still works, but it works on increasingly tight math. To understand what breaks, we need to understand what treasuries actually do. When the U.S. government spends more than it collects in taxes, it issues bonds. Investors, pension funds, banks, foreign governments, money market funds buy those bonds. In return, they receive steady interest payments and the promise of full repayment. Why are they considered risk-free? Because the U.S. controls its own currency. It can always create dollars to pay its debts. Technically, it cannot run out of money. But cannot run out of money is not the same as no risk. Treasuries serve three critical roles. First, they are the global benchmark. Every other interest rate, mortgages, corporate bonds, student loans, is priced as Treasury yield plus something. Remove the benchmark, and pricing chaos begins. Second, they are pristine collateral. In the repo market, the plumbing of global finance, institutions borrow trillions overnight using treasuries as collateral. If treasuries are unquestioned, liquidity flows smoothly. Third, they are the reserve asset of the global system. Central banks hold them as savings accounts. When countries trade oil, machinery, or microchips, the underlying settlement often circles back to dollar assets, usually treasuries. So what happens if they stop being treated as risk-free? It wouldn't begin with panic. It would begin with yields. Investors would demand slightly higher returns to compensate for perceived risk. Yields rise. Bond prices fall. That sounds technical. It isn't. When yields rise sharply, the market value of existing bonds drops. Banks, pension funds, and insurance companies holding trillions in treasuries suddenly sit on unrealized losses. We saw a glimpse of this in 2023. Regional banks loaded up on long-term treasuries when rates were near zero. Then rates spiked. Bond values fell. Balance sheets cracked. Now imagine that pressure, but systemic. If treasuries are no longer considered perfectly safe collateral, lenders apply haircuts. They demand more collateral for the same loan. Liquidity tightens. The repo market freezes first. When repo freezes, institutions can't roll short-term funding. That forces asset sales. Asset sales push prices down further, which creates more margin calls. It's not dramatic, it's mechanical. Meanwhile, the federal government faces higher borrowing costs. With over $34 trillion in debt, even a 1 percentage point increase in average interest translates into hundreds of billions in additional annual interest payments. That money doesn't build roads, it doesn't fund defense, it services past spending. Here's where the math gets uncomfortable. If debt grows faster than the economy for long enough, interest compounds. At some point, investors begin to question not the ability to pay, but the willingness to stabilize the trajectory. And that's the crack in the risk-free label. Publicly, treasuries are described as the ultimate safe haven. During crises, money floods into them. Yields drop. Privately, large institutional players watch fiscal trajectories, demographic pressures, political gridlock, and entitlement obligations. They don't need a default to reprice risk. They just need doubt about long-term discipline. And once yields rise materially, something ironic happens. Higher yields increase interest costs. Higher interest costs expand deficits. Expanded deficits require more bond issuance. More issuance can pressure yields even higher. It becomes reflexive. Now, zoom out. If treasuries are not risk-free, then every asset priced relative to them must adjust. Stocks are valued by discounting future cash flows using treasury yields. If that baseline rises permanently, equity valuations compress. Housing depends on mortgage rates, which depend on treasury yields. Higher yields, higher mortgage costs, lower affordability. Corporate borrowing costs rise, margins shrink, layoffs follow. Foreign governments holding trillions in reserves face capital losses. Some diversify. The dollar weakens. Import prices rise. Inflation pressures return. And here's the quiet irony. The U.S. can always print dollars to pay its debt. But if printing undermines confidence, investors demand higher yields to compensate for inflation risk. The ability to print becomes both the strength and the vulnerability. So, what breaks first? Probably not the government, probably not the dollar overnight. The first fracture would likely appear in funding markets, repo, money markets, collateral chains, the invisible pipes. Because when collateral is questioned, leverage unwinds, and modern finance runs on leverage. The deeper risk isn't a dramatic default headline, it's a gradual repricing of safety, a slow erosion of the word risk-free. For decades, U.S. Treasuries have been the floor of the global system, the asset everything else stands on. If that floor shifts even slightly, the entire structure has to adjust, not collapse, adjust. And adjustment, in a highly leveraged world, is rarely gentle. So the real question isn't whether the United States can pay its debt, it's this: what happens to a financial system built on certainty when certainty becomes negotiable?